Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. It's November the 15th, and for sure, fallout from FTX's annihilation is still happening. But we're going to start things off in other regulatory news tonight. Martin Gruenberg is returning to action, officially. You see, Gruenberg has been the acting head of the Federal Deposit Insurance Corporation since February of this year. That was after the resignation of former chair McWilliams. But this is not the first time Gruenberg's been behind the wheel. He also ran the agency as acting chair from 2005 to 2006 and from 2011 to 2012. He's also the longest-serving FDIC board member in history, with 17 years. Prior to that, he worked on the Senate Banking Committee, where he was a proponent for tougher financial rules. Now, this is like some other positions in the U.S. government. The president nominates, the Senate provides advice and consent in the form of the confirmation process, or not. But if they're approved, then the chairperson will serve for a 5-year stint as the chair of the FDIC. Now, given that the Republicans are not in control of the Senate, the Democrats are, President Biden should have little trouble getting his pick through the nomination process. The president sent that nomination on to the Senate on Monday. Now, as far as how Gruenberg feels about crypto, we only have to look as far back as February of this year. He was talking about the need to evaluate the risks presented by cryptocurrencies when he said, quote, "To the extent such activities can be conducted in a safe and sound manner, the agencies will need to provide robust guidance to the banking industry on the management of prudential and consumer protection risks raised by crypto asset activities." And he's already seen action, and so surprising, FTX is in the news for doing something wrong, but we covered it here when Gruenberg's FDIC issued a cease and desist order. This was back in August. The FDIC issued FTX and 4 other companies letters for allegedly making false representations about deposit insurance as it relates to crypto. In those letters, the FDIC said FTX and others misled the public about crypto-related products being insured by the FDIC. They said representations were false or misleading, designed to lead people on to believe that certain crypto-related products were FDIC insured. Last October, he was giving a speech on crypto-related issues. He said stablecoins present such a potential win for the banking system that U.S. regulators should prepare to make sure that digital tokens aren't disruptive once implemented. And why do we care? While they don't make crypto headlines much, and you don't see them talked about as much on crypto Twitter, the fact is the FDIC is going to be very important for crypto. And that's especially true where it comes to the U.S. banking system and how it's going to mesh with crypto, which is going to lead back to stablecoins, as those rules will shape how stablecoins are implemented. And so yesterday, Gruenberg was back in the thick of it. He was at a meeting at the Senate Banking Committee, and the subject nominally was about the oversight of financial regulators when New Jersey Senator Bob Menendez turned the committee's attention a little bit over to crypto. He said lawmakers need to, quote, "take a serious look at crypto exchanges and lending platforms." Gruenberg responded back with what we already know. No crypto firms are backed by the FDIC, and, quote, "FDIC insurance does not cover cryptocurrency of any kind." And that makes sense. Crypto is not what the FDIC is all about. Investing is not what it's all about. The FDIC's purpose in life is to protect consumer deposits at financial institutions in the United States. That's it. It's there in the case of bank failure, so that if your local bank goes under, your personal finances are unaffected. By the way, FDIC doesn't cover the bank, just the deposits in the bank. And so, Senator Menendez brought up those cease and desist letters requiring companies to stop making false statements about being covered by the FDIC. And he asked how Gruenberg would handle risks from crypto firms. Gruenberg responded, quote, "When we identify some companies in the crypto space and others engaging in misrepresentation, we acted forcefully, sending letters demanding that they cease and desist and indicating that if they did not comply, we have enforcement authorities available to us under the law that we can bring to bear. Not too many people are claiming wins after FTX's implosion. However, Rostin Behnam, he's the head of the U.S. Commodity Future Trading Commission, and he seems to be looking for some bright spots in the whole thing. Looking and finding. Here's what I mean. FTX US's derivatives trading subsidiary, still standing strong. Most of the rest of the FTX empire is crumbling into dust, but the former Ledger X is still doing relatively well. So what we're talking about is the unit called FTX US Derivatives. They have not yet been pulled into this bankruptcy crisis. Not yet. Chair Behnam says that this might be credited to his agency's oversight. He was speaking on the subject Monday at a futures industry event in Chicago when he said, quote, "The reason is because I believe pretty strongly that they are very clearly regulated by the CFTC. It's a testament to the CFTC regulations and the CFT staff and the benefit of having clear, transparent rules." Even back when it was Ledger X, they'd been registered with the CFTC. Behnam said that his agency had been in touch with them on a daily basis, checking on their custodial operations. They said that they were doing it daily rather than the usual monthly time frame, quote, "to ensure member property is where it's supposed to be." And he seems to be happy with the work that his agency is putting out. He did say, quote, "A lot remains to be seen over the next couple of days, weeks, and months, but we're certainly vigilant." Over the last year or so, FTX US derivatives have kicked up a lot of dust, especially when they applied to directly clear their customers' margin-backed cryptos derivatives trades. This was actually something SBF proposed, so we'll see how that goes. That eliminating clearing firms was the way forward. And honestly, I don't disagree with him there. But this first-of-its-kind application that would see crypto industry in the area of TradFi has been withdrawn. He was also asked if the CFTC would be going after FTX. Behnam said that he wasn't going to talk about specific plans. That said, he pointed out that the CFTC does have authority over fraud and manipulation when it comes to trading crypto commodities. Behnam said that they would use that authority to its fullest. And reminding us that the entire universe does not revolve around FTX's Black Swan event, Behnam also pushed back on 4 amicus briefs filed in the Liqu DAO case. These briefs were filed on the DAO's behalf. This was that unit that got sued by Behnam's CFTC back in September. Allegedly, they violated commodities laws because they offered leveraged and margin crypto trading products in the U.S. investors. And they weren't supposed to. But nobody is really sticking up for Liqu DAO so much as the method by which they were served. The briefs that Behnam is unhappy with were filed by Andreessen Horowitz, Paradigm, LexPunk, and the DeFi Education Fund. We're going to talk about Paradigm here in a bit. But the judge in this case, William Ork, they want him to change his minds on the CFTC's motion for alternative service. What happens is the CFTC served by using a help bot and by posting on a forum. The CFTC kind of thinks that's an unfair way to be. They said that they served legal papers the only way they could. And they're saying this because the DAO's official Twitter account acknowledged the suit. That counts as service, as does the discussion between members in the forum. However, opinions on this case are far from universal. Even one of their own, Commissioner Summer Mersinger, has put forth a rare dissenting opinion. She said this enforcement action was unfair and arbitrary. She claims that this will have a chilling effect on DAO participation because it considers all token holders to be voting members, whether they actually voted on anything or not. She said that chilling effect will hinder good governance of DAOs because it disincentivizes voter participation. This inhibits the development of a culture of compliance. Another regulator issuing warnings comes from California. So the goal here is to help consumers avoid getting sucked into the hype machine by providing them some facts. And so to that end, California's Attorney General, Rob Bonta, has decided to make the crypto market less dangerous and less intimidating. So he's issued a guidance for crypto newbies. On the official California AG's website, it now has a page devoted to help new investors by providing them with accurate advice. In a statement, Bonta said, quote, "Don't fall for a fantasy. Cryptocurrency, like all investments, carries significant risks, and there's no guarantee that you'll see large or any returns. Our new webpage is meant to be a resource for Californians curious about this new and volatile market." And so this new page is actually big on investor safety. Now, there is a 2-sentence explanation of what a crypto asset is. There's also a glossary and a warning. Quote, "Even when there are no scams involved, crypto assets can be risky, especially if you don't have enough information to make sound judgments about how you're spending your money." Now, other than that, there's information on scams, warning signs, and ways to keep safe. While there's not a lot of detail, what there is presented accurately. And while there is little legal recourse if there are issues like a scam or something, they did give detailed instructions on how to file a complaint. And they define terms like rug pull. And they remind users that celebrities are paid to shill crypto. They're just not giving out free advice out of the goodness of their heart. In FTX-related news, BlockFi is having issues. On the 14th, they admitted what we knew all along: significant exposure to FTX, which isn't too surprising given that FTX bailed BlockFi out not too long ago. In fact, on the 8th of November, just last week, BlockFi's founder and COO, Flory Marquez, took to Twitter and told us that all BlockFi products are, quote, fully operational. Remember, we talked about that on this show, that they had a $400 million line of credit through FTX US. Now, BlockFi says that they have the capital to manage things, for now. That's what they're saying. But remember, just yesterday they were saying that things were okay, that the majority of their assets were not on FTX when the collapse happened. So we'll see how that goes, because according to the Wall Street Journal, a source close to the matter says that BlockFi is getting ready to file for bankruptcy. And also there's Salt. That's a crypto lending platform. And so Salt has some out there saying that they were pausing withdrawals and deposits to and from its platform immediately. They sent their clients an email, and in that email, they said the collapse of FTX impacted their business. They said, quote, "Until we are able to determine the extent of this impact with specific details that we feel confident are factually accurate, we have paused deposits and withdrawals on the Salt platform immediately." That said, Sean Owen isn't giving up. The CEO of Salt, he said that he denied that this was a sign that his company was going under. He said, quote, "We did not publish this as a notice of going bust. We are pausing to deal with the fallout of FTX and to confirm that none of our counterparties have any additional risks so that we can proceed with maximum caution with all efforts directed at not going bust." More info soon. And Liqu, they're a FTX-owned Japanese crypto exchange. Same old song and dance. Liqu has halted withdrawals. On Twitter, they announced the suspension of fiat and crypto withdrawals from their Liqu Global platform. Meanwhile, Paradigm's co-founder is experiencing some regret for investing in both FTX and SBF. Matt Huang is a co-founder and managing partner at Paradigm. He said the firm was shocked by revelations on FTX, Alameda Research, and Sam Bankman-Fried. He said, quote, "We feel deep regret for having invested in a founder and company who ultimately did not align with crypto's values and who have done enormous damage to this ecosystem." Which I can understand, I guess. So you've got this friend, and then one day your friend does something unexpected and horrible. You're going to want to put some distance between you and your friend. It looks like that's what's going on here. Paradigm is a crypto venture capital firm. They've got approximately $13.2 billion in assets under management, currently the largest venture fund in crypto. On their website, they list FTX and FTX US in their portfolio. Total investment around the $270 million mark. Well, that number has since changed, or it will. Huang said that they never traded on FTX. They don't hold any tokens on the exchange, nor did they buy FTT, Serum, MAPS, or Oxygen Protocols token. He said Paradigm's investment in FTX was only a small part of their assets. It's even smaller now because Paradigm has written that investment off to $0.00. And 0 cents seems to be the perfect way to end this episode this week. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.